public money institutions have been lending into real estate for a very long time. They realize that's good collateral, right? For Bitcoin, we might be 8 to 10 years into the kind of adoption of Bitcoin as collateral. This is where I probably differentiate from a lot of players in the credit industry who don't see this as anything other than a shiny object and flash in the pan. If you want to measure how far are we on this adoption from 0 to 100%, we're maybe 1% for where this can go.
Welcome to the Bitcoin for Corporations show. I'm your host today, Pierre Rochard. We're joined by Matt Dines from Build. Matt, welcome to the show. Happy to have you. You've got a great announcement today to share with us.
Yeah, it's a pleasure to be here. Really excited about the work you're doing with the show. I think, is it 17 episodes in? So honored to be a guest here to talk about Bitcoin and corporate adoption.
Yeah, first I want to start with how did you come across Bitcoin and kind of what your background was going into it?
So when I first heard about Bitcoin, it would have been back in 2011-ish. This wasn't involved. This was just, it hitting my radar. And this is where commercial adoption is significant. I think there was a hotel operator somewhere in inland California and just trying to strum up business. Just made a deal that he, propagated online that, you want to stay at my hotel, rent space for a vacation. I'll take any currency, airline miles, you do equity dollars. And he listed Bitcoin on that mix. And this is at a point when not many people besides the, couple degrees on the Kevin Bacon, 6 degrees of the Satoshi mailing or the Satoshi white paper hitting the mailing list. It was still very small, but I feel like that's the first time it started hitting on a newspaper or a news outlet type of propagation. So I first heard about it there, didn't fully click in, but it was just gradually over the 15 years in its existence that it's been slowly working in until you fully realize what this thing is money. And that's where, Pierre, on your other channel, what you're doing with Nakamoto Institute, those white papers, understanding Bitcoin as money. I'd say it took multiple years for it to sink in. And I think what we're going through right now with corporate adoption, speaking, communicating the message to the C-suites of publicly traded companies, roughly 2,000 in the Russell 2000 index, going from the small caps all the way to the Mag 7. This is a process. So I feel like, we're on that journey, just copy and paste. But now I think we're here to talk today about C-suite adoption.
Yeah, I think I heard someone from the advertising industry mention that it takes 8 times of somebody watching an advertisement. If they were going to buy that product anyway, it still takes multiple exposures for them to really sink in and actually act on it. So I think we're seeing the same thing with Bitcoin. I think every hype cycle, every price cycle gets it back in the news and gets that exposure again.
Yeah, absolutely. Nature's way of just growing an idea, growing adoption. And yeah, exactly. We're on one. And I feel like the primary narrative this cycle in Bitcoin, this is debatable, but it is the Bitcoin Treasury company phenomenon, right? And that the standard right now, the approach for this cycle is, hey, you get a publicly traded company. A lot of them, you can have this come the endogenous route where it's an existing business, which is, I'd categorize those as like Strategy, for example, a legacy BI analytics, business intelligence analytics, software provider realizes, hey, there's something, there's a problem, afoot here. I've got a, $500 million dollar treasury reserve. I'm parked in dollar denominated credit assets. My business isn't growing, to the degree, it once was for, its own natural growth cycle. I've got to figure something out for my treasury reserve. So you have some like endogenous adoption from legacy companies who are, what's the next stage, as capital markets are already always trying to go through that process of creative disruption, right? Or you see, I think this is what's been especially popularized in the last like 6 to 12 months is just the SPAC or the startup where you just launch an equity and, it's reason to try is we're going to acquire Bitcoin on the balance sheet. That's going to be the asset side. And then on the capital side, we're going to issue securities, whatever we can to raise capital, whether it's at the money common equity issuance or hybrids, convertibles, preferreds, or if you can issue, your lowest cost of financing would be a fixed rate, fiat bond, like investment grade. If you could reach it, we don't actually have many of those yet adopting who can tap the IG credit markets, or say a high yield offering. So there's still a lot of room to go, but I feel like that's the primary narrative that this cycle is being built on.
And as that narrative unfolds, I mean, it must be particularly interesting given your background in capital markets. You want to speak to that for the audience to give them that context?
Yep. So my background in capital markets, I won't go, and start history at the invention of the wheel, but just go through the formative experiences. So I did a master's in finance at Washington University in St. Louis. Studied under a lot of great professors, but I consider, the best among them, and the one I'd look up to as a mentor, is a guy named Phil Dybvig, and he actually won the Nobel Prize 2021, I think it was, where they jointly gave it to Diamond Dybvig. Douglas Diamond is a professor from the University of Chicago. They built a model. It's a research paper in the 80s, but this was basically the backstop explainer. It's their standard from the finance academia for explaining bank runs. And then the solution is FDIC insurance, or like deposit insurance at the sovereign level. So the sovereign is the backstop. That idea, I mean, it's basically just kind of cemented the legacy of everything we did, FDR and following, cementing over the kind of the breakage when the credit system couldn't remain solvent on a gold standard, right? 1929, then you get into 6102 and everything that follows from there. And then they split that prize with Ben Bernanke, to give some credibility to the central bankers. But that's how I got into the, I'd say, finance industry as a young lad. And my first job was actually at Citigroup. This was 2012 era, post GFC is where I started, and it was where we were, just sorting through the heaps of, let's just call it, distressed credit from the mortgage-backed security subprime originations those days. So cleaning up, or finding a plan from a analytical perspective for kind of wind down of Citigroup's balance sheet, which was an interesting risk. And that kind of just led me to progress through my career in the 2010s, and then ultimately, what we're doing at Build, which is, and understanding Bitcoin along the way, right? Starting at that early story, I see the headline of connecting all the dots, and understanding how the monetary system, on a credit money standard actually works, which isn't covered, at any other stop in, academia or your career in industry, right? But then understanding how these things all play together, where the purchasing power, or what has to happen to purchasing power of an inflating, credit bubble, and then understanding Bitcoin. That process kind of naturally led to, all right, if we're not going to get everybody to adopt Bitcoin outright as money, the next best thing for addressing the, I mean, trillions of dollars at this point, hundreds of $1 trillion that's tied up in dollar IOUs, would be to anchor them, secure them with onto the Bitcoin collateral layer. So everything we'll talk about in discussion today is kind of part of that process that we've been working on at Build. Go to the source of where the battlefront is. And in our case, it's the fixed income and credit markets, dollar denominated. I'd say the largest, in terms of asset class, right? There's two that would be the king of the mountain, if you will. It's dollar credit and then real estate, right? All of the lending, the mark to market, everything like that of real estate assets that are measured in dollars, right? Priced in dollars. A lot of the housing or the real estate capital stock is collateral for dollars. But if Bitcoin is to emerge as the kind of base money, part of that process is the transfer of the dollar IOU stack and the swap out, if you will, of real estate as collateral onto Bitcoin. So that's what we've been kind of working towards, that whole adoption of the dollar credit, the IOUs, onto the Bitcoin layer.
Yeah, that's really interesting, and the credit markets themselves have been evolving as well, which I think that a lot of folks in the Bitcoin world might not be familiar with. Is after 2008, kind of the explosion of what they call private credit and the financing outside of the banking system. Do you want to speak to that and how that might intersect with the thesis here?
Yeah. So when we say private credit, what does that actually mean? It's a dollar IOU, right? Well, actually, let's roll that back 10 to 15 seconds. What is public credit, right? A public credit in, my framework, these are all loosely defined terms, but a public credit would be something that takes a security form. So it conforms to all of like the New Deal legislation, the regulation, all of that 40 Act, right? But it's what we call today as like a bond, right? And what differentiates a bond from like a private credit instrument or a loan? It's the broker dealer support, in my opinion, and the security aspect of it, which means it's tradable, right? It's liquid. You can quote it in a market. You have dealer support, and you go through the kind of the Wall Street centralized origination channel. So that's a public credit, right? And that system only has so much capacity, right? It can grow infinitely, like it's limited, but it's all about growth rates, right? How much balance sheet capacity can absorb the credit creation that needs to take place to keep the essentially to keep the Keynesian model strumming along without tripping over its feet and face planting on the sidewalk. Right. So we've really seen the growth of private credit, which I'll define in a second. I'll get to, but we've seen this thing take off since 2008, and that what is happening in my mind is the the kind of the legacy system, the infrastructure. It knows there's a problem, right? And when I say the infrastructure, it's people, like the people, the bank executives. They know there's a problem. When you want to lend into, commercial borrowers, that's risk in the credit landscape, right? It's not like the Treasury where you can just, hey, get the debt ceiling raised. We can create more of those risk-free IOUs and stuff them into the balance sheets of the system and then lever on top of that. With private credit, which is not kind of, it doesn't take the flavor or the structure of like a fixed income offering, right? With that broker dealer support is key, the liquidity support. You get a banking kind of industry that sees what's happening with demographics. The growth of this model is strained, and the starting point for that was like 2008 when the gun went off and they realized the system changed. So you can see this in the Fed's H.8 data. The banks themselves are less willing to lend into commercial industrial borrowers, right? That's risk to them. So what those are is small and mid cap commercial borrowers. Could be all the way down to like a family owned, single location business, a gas station, a tailor shop, whatever, up to like a mid-sized corporate endeavor, a large family business, something that's doing manufacturing, et cetera. But they're not big enough to tap the public bond markets, right? Either investment grade or high yield. There aren't actually that many issuers or corporates who can like qualify and meet the criteria to issue a minimum size now for an ag eligible investment grade bond is $300 million. So you've got to be pretty big to actually get to that scale. So you got the banks who don't want to lend into this risk, right? They're levered, starting, post 2008, they're at 10-to-1 leverage, assets to equity. And to address like how do you get the credit capital on dollar credit money, right, into the real economy, to the businesses that actually make things, goods and services that households actually consume. Well, you got to come up with like a less leveraged way to do so, because you're playing what everybody knows is a riskier environment. This is the environment where if you're the management team, when I say environment, like era, like a multi-decade era, if you get it wrong, you'll probably end up being Bear Stearns or Lehman or Signature or First Republic, etc. You get foreclosed, government comes in and shuts you down. Your nice little job at the upper class of society kind of goes away. So you don't want to lose that. So what do? Well, you create a new industry. This is where private credit comes in. When you see a private credit issuer, right, and this is only like $2 trillion right now, it's very small relative to the scale of um, the call it the public commercial banking system in the US, like our actual banks that everybody actually works with, the Fed member banks, that whole layer. That's about 24 trillion in balance sheet capacity. But what you get for private credit is, well, someone needs to lend into the small and mid market, business endeavors. If you don't have that in the real economy, there's no production of goods and services, right? That's what they're there to do. So with private credit, what you get is essentially you'll find like a bank sponsor or a pension sponsor. You need your funding, right? But instead of being levered 10 to 1 like the banking sector, private credit is typically like they'll top out about 2 to 1 or 50% split between debt and like fixed denominated liabilities on the capital side of the balance sheet and then equity. So it's a much, I guess it's still levered, pretty significantly compared to, other types of corporates. But what it's been invented, why is it kind of profligating? It's there to lend into risk, but do so in a way that, ideally, from a structural standpoint or a regulatory standpoint, doesn't result in more 2008 or 2022, 2023, hiccups. And it's not the secret's out. It's not going to be able to avoid it when you're on a fractional reserve, right? But this is the approach. This is why private credit is proliferating. So, one other kind of just feature of private credit dollar loans, they're private loans, which means the borrower and the lender kind of engage on a bespoke basis. And when I say a lender, it can be a tight knit group, a consortium of lenders, 3, 5, 10, et cetera, who pool their capital together to fund the deal. But you don't go through the broker dealer channel. They have their documentation and all of that in place, but it's not like a public offering where you see a prospectus posted to broad public markets. It's tight, it's closed. There's probably some other important features we could get across, but I think I've hammered them in home. That's what's going on, and there's actually not that many like deals that are funded. It's when you think about QSIPs and the public market for fixed income and credit, there's like tens of thousands. Like the number of bonds that JP Morgan as an institution has outstanding is like just shockingly large, like 10,000 plus JPM QSIPs trading. Not all of them are as liquid as others, right? Not all of them are as large an amount as outstanding as others. You've got a massive size and quantity in the public debt markets, and private credit, it's much smaller. There's about like 150 deals a year. You can track them on a Bloomberg worksheet, but it's not that big. But what's going on is the risk sector of commercial industrial borrowers, it's shifting from like tilting away from banks. Banks still want some of that business, what they see as the top of the like the cream of the crop. If you're thinking about this from that type of analogy, but to lend into the whole pool, the banks won't do it all. So you've got to have the private lenders step in.
And so, when we look at Bitcoin credit markets, obviously they're very nascent. You're at the forefront of developing that. How would you evaluate where we're at with Bitcoin? Now that it's 16 years old, relative to other asset classes, like you mentioned, real estate.
Real estate's been kind of tried and true for, I mean, the entire call it like post 1492, European Renaissance order. Like banks, finance, we public money institutions have been lending into real estate for a very long time. They realize that's good collateral, right? For Bitcoin, I would say we might be 8 to 10 years into the kind of adoption of Bitcoin as collateral. It didn't start until it was definitely post Mt. Gox, right? Somewhere in the 2015, 2016 era. So I'd say, maybe half of Bitcoin's, entirety of like 15, 16-year existence, we saw the emergence, the first step on the adoption curve for Bitcoin as dollar credit collateral. This is where I probably differentiate from a lot of players in the credit industry who don't see this as anything other than a shiny object and flash in the pan. I think this is like if you want to measure how far are we on this adoption from 0 to 100%, whatever 100% is, like, is there a steady state? We're maybe 1% for where this can go. And I can get into the why throughout our discussion.
Yeah, let's do that. I mean, do you think it starts with the volatility or just the ephemeral nature of a digital asset?
So I don't treat Bitcoin as ephemeral, right? The 21 million Bitcoin
Yeah.
are by definition non-ephemeral. They're long lasting, and the only thing that changes with Bitcoin out of the 21 million hard supply, once you wrap your head around that, is where or who is the ultimate beneficial owner. And I think that's just starting to set in the cities that are treated as global money centers. Today, New York, London, Tokyo, Hong Kong, Dubai, etc. It's starting, but yeah, we're just getting there. So why is it not being adopted? I would say first you have to have capital that's willing to lend in, and then you also have to have a borrower base who ultimately reserves Bitcoin on balance sheet. And I think you're starting to see, all right, you've got Bitcoin denominated uh, corporates, right? This is like Bitcoin treasury companies, but it's actually they're starting as business owners, corporates, equities, etc., who make the switch to view, hey, Bitcoin is my unit of account actually. And there's nothing in GAAP. You still have to report your financial statements in your local currency, your sovereign currency. But from a strategy perspective, this is the strategy name, like you're on the Bitcoin numeraire or like unit of denomination. So you have to have a borrower base. You have to have some engagement and productive, economic activity, and then you have to have dollar capital that's willing to lend into those and build those markets. And I'd say all of those things are playing off each other as we work up the adoption curve. And this is something that can be, a multi-decade trend in my view.
And for the last piece of the dollar capital, I think one of the reactions is, well, if somebody is comfortable lending against Bitcoin, why wouldn't they just buy Bitcoin, right? And so I'd love to hear you speak to that and how you think about the different investor classes out there.
That's where you ultimately get. I think that's the logical conclusion. And as I go in, to my first meeting, if I'm meeting with an investment committee or a board, and they're looking to allocate into a Bitcoin backed dollar loan, I always tell them it's like, all right, we've gotten to this point. You're starting due diligence. I'll make it clear in the first 5 minutes of the meeting. If you all find yourselves willing to do this, you got to realize, who are you lending to? You're lending your dollar capital to another business who is on a Bitcoin reserve. If you're willing to do that, you trust the liquidity of the Bitcoin market to protect your collateral, if you need to liquidate, protect principal, etc. The natural logical endpoint where you're going to arrive in 18 to 24 months, once you realize, you've dipped your toes in, you're going to come to realize you should own the Bitcoin. But some people, like, it just takes time. Or maybe there's constraints. Hey, we can get this through the investment committee right now through the existing kind of policy guidelines, investment allocation framework, all of that. Well, we don't have a spot for Bitcoin right here. We don't know how to plug it in. But if once you dip your toes in, then maybe even if you have a board and investment committee who wants to adopt Bitcoin from the get-go at those due diligence meetings, maybe in 18 to 24 months, they'll have that kind of ammo they need to make the push to say, hey, we do need to reserve some Bitcoin on the balance sheet. That's possible, but it's also sometimes it's just people wrapping their heads around this is very difficult, and they just see the performance of the dollar credit. They say, hey, this is better. This is giving me a better total return. We can wrap our heads around the risks. We like the structure of the loan documents. Everything's good. The hoop they have to jump through mentally is saying, hey, Bitcoin's a worthwhile collateral to lend into. That's a step ahead of realizing Bitcoin is a better money. I need to reserve the better money. So it's part of a gradual process. And even still deals that go the distance, you close the deal. In my experience, it's been the case where I do everything I can at the intro of the due diligence, point them to the Nakamoto Institute, point them to, our friends who've written high quality, work explaining Bitcoin as money, you still can't get there often. So that's kind of why you see that first step of adoption is, oh, first we're gonna adopt at the dollar credit IOUs, not at the base layer. But eventually they realize they need to go down to root in the file system, and that's the in the long run the safest place to be.
Yeah, and is it with the credit funds, their mandate is really to lend dollars, and not necessarily to invest in a commodity, no matter how promising they think that commodity is. Their role and their career is centered around avoiding volatility, right? So, is there a different culture within those companies as well, where they look at a price chart and that all they see is, haircuts on LTVs?
When we say culture, I think a lot of it is just, what's the age group of the portfolio management class today, right? Or CI, chief investment officers at firms today, or executive board members today. Probably maxes out like retirement age 65. Some people might stay on till 70. But if you roll back the tape, when did they begin their careers? 1980. I think the dominant mindset is in that 1980 to 2020, part of the monetary cycle of what's been a bull market and credit expansion that followed, the breakage that took place from, Bretton Woods, it started in 1968, really, with the Silver Certificate Act, breaking the redeemability of Federal Reserve notes, redeemability for the households and public sector private sector for everyday, backing of money with silver, right? And then you broke it in 1971 with Bretton Woods. But everybody's experience who is alive today on these boards is built up in that 1980 to 2020 era. So that's the dominant mindset that you're meeting in boardrooms. That is the culture, right? And if, once in a while, you'll find an individual who just loves reading about financial history or monetary history, but that's few and far between. So you don't have the paradigm to actually communicate to these people for how this works and monetary cycles measured in centuries. You're just most people are just focused on their culture, their investing framework, their experience is just built on what they've lived through in their own lifetimes. You know, most people, like, financial history for most people starts in the 1980s, and then they're vaguely aware that there was a market crash in 1929, but if you want to keep filling in the blanks after that, it's very sparse for most people's mental models in my experience, and a lot of it's not taught in undergraduate, university levels. It's not really taught or tested in the kind of credentialing bodies like the CFA or Kaya or Chartered Investment Advisor, like all of those, like it's just not addressed. So people only bring a very narrow experience of what they've lived through, and history is kind of not ignored. So then when you're trying to merge it into this, new thing that shows up, a hard monetary ledger built on information and electronic communication, they don't have anything mentally to foot to, right? And then you just hear, finance bro deliver statements like Bitcoin has no intrinsic value, or those things. And for me, that's just kind of the signaling mechanism. It tells you exactly where they're coming from. So those are actually helpful because you know what you're dealing with from an understanding perspective from the get-go.
And do you think there's also education that maybe in the past it was true, right? That Bitcoin was small and illiquid, and they haven't really updated their figures on the size of IBIT and of CME futures. And so the liquidity figures they have in mind are just out of step with where the market is today.
I think it's quickly becoming um, accepted knowledge that Bitcoin to the dollar, trading pair at, like, when I say dollar, like a bank deposit versus a Bitcoin UTXO, that's the FX market. It's becoming clear to people that that is a massively liquid market despite the volatility, right? So it's emerged. People realize, or investment professionals are realizing, hey, for foreign exchange, you got dollar euro, dollar yen, Bitcoin to dollar is somewhere in there in terms of liquidity. And then it's rapidly becoming kind of ingrained or common knowledge with finance professionals with, hey, why do we like the the short-term treasury bills so much for collateral, right? Repo lending is the most popular, short-term, money market really for the entirety of the system. Why is it so popular? Well, the T-bills are liquid, right? Each issue might be $70 billion. You trade them at par, so that's where you get the low volatility, but you get massive liquidity. So if you need to liquidate, you have something to sell into to protect a credit, right? Well, for Bitcoin, the spot pair in terms of volume and liquidity, it's now getting on par not just with the large foreign exchange pairs, the dominant, developed market G7 currencies that trade with each other. It's also, emerging as, on par with liquidity as, your treasury bills, which are the most liquid and functionally important, collateral in the entirety of the fiat dollar system.
And trading 24/7 as well on the Bitcoin side that you might not necessarily have access to for other assets.
Yep, you can trade, you can execute an order, and we call it like you can send the ticket, strike a deal with a counterparty 24/7, right? Saturday night on a weekend if you need to, respond to news. The market maker's active on, Saturday night for, a geopolitical event. The settlement still has to take place within the 9 to 5 Monday to Friday hours of the credit system, right? You got to have butts and seats in London, Tokyo, New York, et cetera, to actually like achieve final settlement on the dollar ledger for that end of the trade. But I think that's also rapidly changing. You can start to see legislation, with like Fed now. The impetus was we need to shorten settlement times. They've realized that. So you went from T+2 to we moved to T+1, in the last 12 to 18 months for settlement of say corporate bonds, right? So everything's T+1 now, and they're investing in rewiring their own, ledger money settlement system down to, can they achieve final settlement in 10 minutes like as Bitcoin does? We'll see. But yeah, they're trying to actually meet the product features that Bitcoin offers with 24/7 trading, and then as well the continuous settlement aspect. But Bitcoin as the disruptive technology has already offered that. Now the legacy, the incumbent, needs to match that feature set parity as well. So that's another trend in progress.
Yeah. Now, on the Bitcoin side, we mentioned the size of the collateral. It's now north of $2 trillion market cap. Um, how much of that do you think is currently financed, right? Where somebody is borrowing against their Bitcoin, versus other asset classes? I imagine almost every home in the US has a mortgage on it. Do you think that it's going to grow that quickly, or that there's limiting constraints or perhaps even a disinterest in borrowing against Bitcoin that is a headwind for that?
I think, okay, to estimate the size of the market for dollar lending, anchored to the Bitcoin collateral layer, right? You got the market cap, the liquidity profile in the spot exchange market. That's the base, right? And if you don't want to build the Tower of Babel up too high, right? More credit on top of, the base layer, the higher you build, the more likely you are for that house of cards to crumble, right? So as people are borrowing, taking on leverage, this is, in my experience, the number one or number two. And these things are coupled at the hip, but the things that drive the volatility on the price cycle, right? People overextend leverage inside of or on top of the Bitcoin collateral layer. Once you get ahead of your skis, that credit, realizes, hey, we've created too much credit relative to what the borrower base can support and the liquidity profile can support. Once you liquidate, everybody gets liquidated at once because of the euphoria or just temperament, how people are viewing the asset class, and that's how you get the boom and bust cycles built up on this process. But that's actually the volatility in the price chart, right? From sources of volatility or uncertainty, right? The Bitcoin ledger, from a monetary supply framework, that's fixed, right? There's no uncertainty there. Once you wrap your head around it and you come to the conclusion that the monetary policy is, for all intents and purposes, clear and certain, right? Well, if there's volatility on the Bitcoin dollar price chart from a monetary framework, it's not coming from Bitcoin. It means it's coming on the dollar side, right? And this is where just human action and adoption come in, and as investment decisions get made. So when you think about how do you get too far ahead of your skis on the credit layer on top of Bitcoin, there's no aggregate reporting anywhere on total dollar credit originations backed by Bitcoin. You have to map this out, as a practitioner like Build or an individual who's interested. You have to use your own data sources to estimate, where this is. But you can back into some order of magnitude, right? Just based on, all right, what are lenders originating at LTV? Some of these lenders will come out with public statements, how much they've lent into Bitcoin. For example, Nashville 2024, Howard Lutnick, before he was part of the Trump administration, this predates the election result, came out and said Cantor Fitzgerald is going to allocate $2 billion of its balance sheet capital to Bitcoin-backed credit lending, right? So you get a sense of, okay, well, the market can support 2 billion from what's probably one of the largest lenders. That's not going to be 100% market share. Is it 10%, 20%? You can come up with some just scenario analysis. And then we also know from a margin loan or a secured loan, what margin calls or protections do you have to have in place such that your loan or the principal balance doesn't turn into a distressed credit, right? And that's where you get into some lending shops, 2022 cycle, not necessarily focused on Bitcoin exclusively, but the BlockFi, Celsius, et cetera. You get a sense of how, at what lending standards do you get over your skis, right? So you can back out in terms of like sound lending that's not going to lose money from credit capital standpoint. Put all these things together and get an estimate of, all right, how large is the credit stack, if you will, of Bitcoin backed loans out there, and what can that spot market actually support, right? Because if Bitcoin market cap is at 2 trillion, the amount of credit outstanding is some fraction of that follows the growth of Bitcoin's market cap as a proxy, right? And it shouldn't be 1-to-1. If you're doing too much lending, that means you're getting ahead of your skis. Same way that, say, banks in the 2008 era, lent way too much into subprime or got way too enthusiastic about credit creation. Ultimately, that has to wash itself out because the real economy can't support it. So you can get a sense of, how big is this market? So I'd say right now it's probably it's in the order of magnitude is how the most confident you can be is just getting the order of magnitude right. I'd say we're somewhere at this point between 10 billion and 100 billion outstanding. Now, exactly where we are in that number, it'll depend. It can change week by week, month by month, but I'd say that's about the market size right now. And just for context, the credit markets, I mean, within the US, domestic economy, you can see this on the Fed Z.1 report. It's about $100 trillion of credit that's, reported and captured in this data set that the Fed aggregates and publishes. That doesn't include or not all private loans. There's layers on top of that. So actual IOUs outstanding may be, in addition to that number, like for the US economy's concept. And then you go to the offshore, we really don't have an idea, a good notion of how many dollar IOUs have been created offshore. That market is shrinking because of post-2008 monetary policy, but, tack on another, couple hundred trillion easily for total dollar credit out there. So for scale, 10 to 100 billion, this is still very early.
Then if we look at the kind of the borrowers, you have individuals who might access a platform like Unchained. There's large corporate borrowers like at the other extreme Strategy. So when we look at what Saylor's doing, he characterizes it as essentially tapping into the fixed income market with these preferred equities. Do you think that there's going to be particular avenues of growth that really outpace each other, or is it going to be pretty broadly, evenly distributed growth?
So for specific, on the capital side of the balance sheet, like each, where you stack rank and obligation, um, each of these kind of tranches, if you will, or, secure or like pools of capital that you can tap into, they're of massively different size, right? And I'll get into that. So you got debt at the top, the most senior claim on the firm, right? And at the bottom, you'd have the equity as kind of the residual, the risk layer. So far, we've seen, take place for the Bitcoin Treasury company. And let's just define a Bitcoin Treasury, any company that reserves Bitcoin on the asset side of its balance sheet, like Bitcoin is its monetary reserve. So far, we have gotten into from, penetration into those, capital pools. We've seen convertibles. We're just starting to see preferreds. We haven't even touched the actual bond market, the high yield and investment grade, securities that come with a prospectus. They're broker dealer supported for liquidity purposes, custodied by, these qualified custodians, start with like BNY Mellon or just Bank of New York now is what they changed their name to recently. But that bond world, we haven't even touched that. So these preferred offerings from MicroStrategy, Strike, Stretch, Strive, I don't know, I can't remember the other one. That's still not even in the big game, right? And for orders of magnitude, right? The actual investment grade for commercial borrowers, right? Because we talked about the total stack of dollar IOUs outstanding. You got to cut about half of that is going to be gobbled up by the sovereigns and like US Treasury bonds, or you'll see other sovereign issuers who issue US dollar denominated fixed income on the post World War II dollar standard. A lot of countries don't even control their own monetary policy, or they can't fund themselves without tapping into the dollar's capital pool, right? So take off 150 trillion as addressable market, something like that, like that range, because it's sovereign debt. You're not going to be able to touch it. That's not even going to be addressable for commercial borrowers, and it's going to remain that way for the foreseeable future because we've got several trillion dollars. Speaking to the U.S. perspective, we have several trillion dollars of unfunded liabilities for Medicare, Social Security, future interest payments, future defense obligations that aren't even reflected on the balance sheet. That's credit that's going to have to be issued that hasn't been captured yet. So about half the market taken away, sovereigns, right? The other half, and this is what traditionally has been a large player, but is shrinking in the post 2008 kind of environment, is private sector borrowing by households, right? So the biggest chunk of that will be mortgages on a primary home. And you see that, with Fannie and Freddie and conservatorship, um, that's leveled off. So you're not seeing credit creation from the households yet. That's actually slowing the growth in this, fiat denominated economy down. And then you get into the commercial borrowers. So corporate lending, the big kahuna. We talk about what we've addressed so far with the preferred and convertibles. Those are small beans. Like that is, maybe $1 trillion market in total. Like I'm ballpark. That's probably not too far from the truth. Um, Once you get into the corporate bond market for investment grade issuance, then you can start getting up to numbers that are somewhere in the 10 to 20 trillion dollar range. We haven't even tapped that yet. So as far as how far commercial borrowing has gotten on the Bitcoin collateral layer, it's still very early on growing its share of market within the corporate lending sleeve of this entire fiat credit system.
So, you mentioned sovereign borrowers. We heard a proposal from Bitcoin Policy Institute to kind of combine Bitcoin with treasuries. What did you make of that proposal? Is beyond just lending against Bitcoin, these hybrid approaches of lending against Bitcoin plus other collateral?
I think it's bound to happen, the sovereign adoption of Bitcoin. And I think the will is there at this point with this administration. I think it's obvious if you look at leadership. Um, they're signaling they're working on ways to adopt or port the U.S. Treasury financing mechanism onto the Bitcoin uh, protocol, right? The problem is the tactics or strategic approach for actually getting it done. We've seen in the past gold index, long-term treasury bonds, those type of securities. Um, those have never actually punched through. That's not a new idea on the fiat money standard. Hey, we're running out of capacity. Well, let's borrow against our gold as collateral and piecewise share some of the gains denominated in a fiat unit of account between borrower and lender. Those have not gained adoption, across the world's sovereign borrowers and the lenders in that market. I don't have the perfect reason for why. Is it market structure? Is the lender just not interested in that? I don't know. I don't know how it's feasibly going to get done. Just meeting of the minds and making the marketplace. I think after that Bill Pulte email or sorry tweet on June 25th of this year, and the one I'm referencing is the policy directive to begin um, treating crypto assets, right? Throw away all the other stuff though. It's about Bitcoin is the enduring value there. Treat the borrower seeking a loan for a home mortgage for a primary residence. Treat the Bitcoin collateral as mark to market, in the qualification process for that loan origination. I see that as a step towards that sovereign adoption through the GSEs, the government sponsored enterprises. Why do I say that? Well, once you start realizing, hey, this is coming from a Gemini report in July, you've got 51% adoption by Gen Z of crypto, right? And you just, hope that they're actually, when they say they're adopting crypto, that they're buying and holding Bitcoin, not all this other crap, right? That's going to get them rugged. But for some portion of them, it is Bitcoin, and they're accumulating Bitcoin as their money, right? And when you look at the long-term trends of where things are going, look to the young people because that's the future, right? My grandparents who never actually, they're 90s, they're gone. They never actually signed up with their ISP, never had a smartphone. Like they've for the last 15, 20 years, 2008 and beyond, they just kept doing money and banking the same way they were doing before. The new habits start with the young and they tell you where the future is. So you see the adoption at the borrower level with Gen Z. I'll just hope they're holding Bitcoin, right? They're going to need to show up what they still want as a primary need on Maslow's hierarchy. They need somewhere to live, right? So they're going to go tap these New Deal institutions, Fannie Mae, Freddie Mac, that are built to provide capital to fund new mortgages for your youngest cohorts of society, to get that credit creation available to fund the purchase of a new home and kickstart the economic growth of that entire monetary model. Problem is you can't qualify them, right? If your median house price now is something like 350K to 500K, somewhere in that range. Median wages or median annual income for a household is $80,000, and maybe that skews even younger. And then interest rates now want to move up because of the dynamics of these dollar IOUs are not holding their purchasing power since COVID acted as catalyst to get the ball rolling. And the bond market realizes that. So we have to have higher interest rates. All of those things put together means how do you qualify your Gen Z new home buyer if you don't count their crypto, their money as an asset? So that's where you actually have, in my mind, the forcing function for GSC adoption. It's a must-have because you got to meet supply and demand. It works for both sides of the marketplace. And then you do the step one at origination to qualify. Hey, you can count the Bitcoin. That counts as their collateral. We'll qualify you that. But then eventually, I think this works through the mortgage lending industry where you realize, hey, we should actually, instead of charging a fixed rate for 30 years on a new real estate property or purchase, we probably want to have some exposure to that actual good money over there. So I think that's how you get the exposure built up on the Treasury's balance sheet. It's going to come through those the GSEs, and it'll ultimately be supported by the demand for the currency, the Bitcoin, from the youngest segment of the population. So I think the approach for a Bitcoin backed, fiat loan where there's some sort of, profit sharing in the Bitcoin collateral, I don't know that you can actually make the economics work for the lender, because they're just going to be better off. Say, why don't I just buy the Bitcoin right now rather than this hybrid bit bond where I'm actually not better off. I'll just split this, buy some of the Treasury, buy some Bitcoin, show me you can do better. In reality, it's very hard to make something, add value from those two ingredients. You don't get, 1 + 1 is greater than 2 there, or it's very hard to squeeze that out. But for the Gen Z borrower, I think there is something there because they start with no assets, right? Most people begin their lives with, a zero to their name. They don't have a family business or a trust, et cetera, that they inherit. So they have to build their own balance sheet through the sweat of their brow, hard work, ingenuity, all of that. So if they're working, the young have time, strong backs, all of that. Um, they build up Bitcoin as their reserve, and then because of the valuation, of the Bitcoin, it's treated in the qualification. They can now get credit on 15 or 30-year terms and get that balance sheet expansion, but still be measuring their reserves on the Bitcoin standard. And I think from there, you're actually getting real balance sheet expansion. There is the whole is greater than the sum of the parts there. And part of their Bitcoin accumulation strategy then over the next 15 to 30 years, that time that young person, that Gen Z or late millennial or these Gen Alphas who haven't even entered the workforce yet, they'll be out there working. They can still pay their mortgage in the fiat dollar and create that demand. But ultimately it's about they'll pay their debt obligations, but everything else is going to go into the Bitcoin reserve. That's what can be shared. And then I think you actually have some value creation, and that's how you get the Treasury's balance sheet to grow. Which the other constraint you're dealing with as well is Treasury has to, like under the executive orders, the policy directive, they know they want more Bitcoin on the balance sheet, but it can't just be through increases in the federal borrowing, right? You can't just issue debt to buy Bitcoin. It has to come up in some other way. And this is where I think the GSEs and the reform, coming out of 2008, coming out of conservatorship, this is what I view as the most likely path.
And it seems like beyond just integrating Bitcoin into their underwriting process, that it's a hot topic of yes, getting out of conservatorship, but also seeing Bill Pulte, uh, asking for lower interest rates to unlock the mortgage market. What do you think the impacts of lower interest rates would be on Bitcoin and on the credit markets in general, looking at the next 12 months?
Yeah. So I think, post COVID, we're on the other side mountain of a monetary framework's useful life. You had the credit buildup from, the 1971 to 2020. We're walking down the crest, right? And we may have been since 2008. But what we've seen since, the Fed started hiking interest rates in 2022, what happened, where the amount of debt in the system is relative to the actual amount of economic activity to support that debt. What we got at 130% public debt to GDP, once you hike interest rates from 0 to 5.25, what you effectively did was, yeah, you constrained credit creation, but in terms of the debt stack, um, a lot of the new money creation just went into interest payments to the existing debt holders, which is essentially um, it's a monetary injection, right? So this is where you see $7 trillion in money market funds earning 5% yield. That interest income stream just goes straight into, some of it goes into consumption, but then it just goes straight into other assets, right? And so what we learned in this environment, this setup, just given where that monetary system is, hiking interest rates wasn't actually constraining on the real economy, right? So what happens now when you cut interest rates and that dynamic? Well, you're going to lower that income stream, and those flows will now, like, if you were a retiree and let's say you had $1 million nest egg and you just felt like the safest thing you could do is buy money market funds earning 4% or 5%, like they've been doing the last 2-3 years, right? Instead of 40,000 to $50,000 a year. Well, if we cut rates another 150 basis points, as Treasury Secretary Bassett, came out with a statement this morning, well, you're going to lose 15 to 20K off of that number. And for that retiree, all of that's going into consumption. But for the $7 trillion in money market funds that exists, that's dollar flows that aren't going into other asset purchases. So you get somewhat of a constraint there, but by cutting rates on the short end, you're also at a stage where, instead of, if you just left interest rates at 4% in perpetuity, that income stream would go out forever, and it would just keep buying assets and pushing them up into the right. What we're actually going to do by cutting interest rates, you're diminishing that income stream, for the next 2-3 years, however long we can keep rates lower at this point in the cycle. But what will happen there, in my opinion, or is likely to happen, is, all right, we cut those interest income flows, but what you did on the other side is you actually encourage, by lowering rates on the front end, you encourage new credit creation, like just balance sheet expansion in the system, like just period, right? So it'll be new treasuries. You cut interest rates, well, you're going to start seeing more advertisements on TV for, hey, buy my new car for 0% money down, 5 years, 7 years. You'll see new credit creation on that route, which is still monetary creation. It's the same thing. And then you get into the point of the cycle where, hey, we've already, at some point, we'll squeeze all of the blood from that rock that is left, that thing can produce in terms of economic growth. Then price levels start to rise again, what economists today call inflation, but misnamed, right? It's not quantity of money. Well, it actually is. Like if you're looking at credit expansion, and then you have to just rinse repeat. So I think what it does is it just leads to, we're on a path where, fiat system on the other side of the mountain, instead of 40 years of lower highs and lower lows to solve the problems in the economic system, we're on the other way. So it wants to trend higher. Interest rates want to show higher highs and higher lows. So I expect, rate cuts right now. It'll make new credit creation easier for borrowers, but I don't know that it would be optimal to go back to zero for the system, and the inflation potential that we now know exists in that system, to reactivate that or push it too hard. After what we saw in 2021, 2022, from a policy standpoint, I'd hope they'd be a little bit reluctant to pull that trigger, but that's kind of what I expect to happen. So more credit creation, but then, on the back end of that, those new borrowers will have to, they'll eventually, it's the game of musical chairs, right? Well, we'll pull chairs away and then the music will stop again, and rinse repeat.
Yeah, that makes sense. That is the fiat cycle. So I want to bring it back to the announcement, though. That was kind of the impetus for this conversation, which is the partnership between Acacia, Unchained, and Build. I'd love to hear in your words how this partnership came about, and kind of what the outcomes are expected to be for the different parties.
Yeah. So how this came about, just through reputation. I think you just make connections in capital markets. And if you're on the right track, operating with integrity, eventually the market or suppliers of capital find you. But it's a long game. I'll just put it at that. But that's essentially how you find each other. You have shareholders or, you know, advisors, pensions, et cetera, who may allocate to you. And then, they talk at conferences. these ideas kind of trickle through. Um, and individual balance sheets, they're all facing a problem in this environment. And that's where we'll get to the public company adoption by a Russell 2000 index member. Everybody is dealing with the problem of the fiat money standard, right? And even as a public equity as well, trying to grow your own business, your income statement. Markets are in this constant process of creative destruction, as I've mentioned. If you're company management or your board, you've got to come up with a plan for how you're going to create shareholder value. How do you make your stock price, go up and to the right, or perform? If you can't beat the market, well, you better not be a laggard, right? So I think it naturally comes to that where every company at some point will face the challenge that operating on this monetary framework will ultimately come to fruition despite your business, or despite the strength of your business. Even if you're a stalwart, a mag 7, at some point you're going to be in slowdown. And if you look at even some of the mag 7, um, look at Amazon the last 7 years. It's not as bullish as you would look, right? So all of these business models, you've got to come up and stay ahead of trend, and that's just the nature of the competition. So for this particular company, Acacia Research, this is a company that went public, and I want to give a disclosure too. So this is intended for informational purposes only. This company is a client now, and it's publicly disclosed after Wednesday's press release, the announcement. And this is also not a solicitation to buy or sell any security. So if you do have questions on this or want to learn more, go to your financial advisor. If you have one, discuss this with them. And anything I say is subordinate to the company's disclosures, investor relations, and management communications, like through the recent earnings call. So just want to make that fully clear. But this business Acacia, I would say, it's in that state over the last 10 years of kind of reworking itself after its original business model, which was kind of built on patent assertion for inventors who had developed, let's say, a biotech patent, and they need help monetizing it or bringing a product to market. That business has kind of played its natural course, and the company is still involved in that business line, but they're gradually under new management, coming up with new endeavors, new businesses to invest in as an acquisition company. So there's multiple kind of swim lanes that they're focused on right now. Some of it is industrial, some of it is energy production, oil and gas, and the Anadarko Basin and the Oklahoma, Texas region, stuff like that. But I'd say the hallmark of this company, if there's one thing about them as a Russell 2000 member, they're a company that's sitting on a cash stockpile and cash per share that is basically the stock price is basically trading at cash per share. So management is faced with the challenge, or the problem, if you will, to solve for them, is how are we going to focus on creating value here? What are the new businesses to get into? And that's where you start a process of due diligence, et cetera. He's like, hey, so may start a conference introduction. They're talking with a friend or a colleague in the industry. It's like, well, we're focused on crypto, or someone there might say, hey, you should actually focus on Bitcoin. You should talk to these guys who can help you as a river guide navigate that whole new industry that is still less well understood, I think, than where it needs to be. And so you make those relationships, and ultimately find out, all right, how are we going to create value out of the cash stockpile? And if the answer right now for a lot of executive committees isn't, we're just going to do the Bitcoin Treasury company route, the same thing, you see a lot of new offerings coming to market there through the SPAC channel. Maybe you're not willing to do that, but if you're already sitting and focused on, you're sitting on a cash stockpile on your balance sheet, and that's just sitting in money market funds, you wrap your head around these trends. What is actually going on with Bitcoin? Is there commercial adoption? All those things. Yes. Check the boxes. Can we pass due diligence? Does that industry? We talked about the adoption framework, right? Where is Bitcoin backed lending, or that market at in terms of its adoption cycle? I said earlier, I thought it probably didn't get underway until 2015, 2017, somewhere in there. You didn't actually have institutions like registered investment advisors, like credible infrastructure for a company like this to even lean into until, probably early 2020s. But it's been built, it's there, and we're just starting to see the fruition of those trees growing on those, plots of land that, a lot of companies and individuals have been developing within the Bitcoin industry for the last, 5 to 10 years.
Yeah, that's a really interesting background, and it's exciting to see the growth there. And we'll certainly look forward to having you back on, Matt, as the credit markets around Bitcoin continue to develop. Thanks for coming on.
Yep. Thank you, Pierre.